Welcome to this webinar titled International Tax, brought to you by ASWATAX, Chartered Tax Advisors. As you can see, my name is Omar Aswat, and thanks for joining us. I think a few more people will be joining, but if not, the recording will be available. And we're just speaking before the start of this webinar that international tax is becoming more and more of a common issue. You could say issue in the sense that it needs to be navigated well. So a lot of people are thinking of leaving the UK, and many still have an interest in the UK in terms of still finding the UK as an attractive potential investment. So investing in the UK is still potentially attractive, but broadly speaking, in recent years and in terms of the type of work that we've been doing, it's primarily advising those that are looking to leave the UK. So international tax, it covers a wide range of areas. Before we go on, I'll just say a few things about ASWATAX. So we're Chartered Tax Advisors, regulated by the Chartered Institute of Taxation, founded about 3 years ago, just coming up to 3 years. And in terms of the types of services we provide, broadly speaking, we cover all taxes. So when it comes to UK taxes, we can more or less advise our clients. So in terms of our clients, we have high net worth individuals, ultra high net worths, assets in excess of 5 million, business owners, property landlords, and as we say, individuals coming to and leaving the UK. And a lot of the times I see that when we say individuals coming to and leaving the UK, they'll have some sort of connection with the first three that I mentioned. Either they are high net worth, so they have, assets in the millions, whether that's property, shares in a business, and that's where we cover the business owners and the property landlords. We do have the individuals coming to and leaving the UK in terms of strictly from an employment perspective. So they've been employed overseas, and they're not really and truly leaving anything behind in the UK, although that the case is more around, usually someone leaving the UK, a lot of the times they'll have UK property, for example. So these are the angles that we cover. And in terms of the actual tax elements would be around inheritance tax planning, income tax, capital gains tax, property tax, and the rest of it. So the key areas that we'll be looking at today would be the statutory residency test, split year treatment, the remittance basis of taxation, foreign tax credit relief, domicile status and how that's relevant, coming to the UK, leaving the UK, the tax issues surrounding those two, disregarded income. Disregarded income is very specific for income tax purposes and quite useful in certain scenarios. Non-resident landlord meaning, therefore it's relevant for UK land and property. So we're looking at UK land and property and how a non-resident landlord is taxed on his or her UK land and property. And we'll be looking at a couple of case studies. So if we get straight into it, the first matter at hand would be the statutory residency test. Now, the reason it's the first matter at hand is because the whole thing about international tax and coming to and leaving the UK, it's directly relevant, or I don't want to say directly relevant, because for inheritance tax, and keep this in mind when we come to certain topics, and I'll remind you again, but inheritance tax is directly related to domicile. So it doesn't matter whether you're a UK resident or not. For inheritance tax, we're looking strictly at domicile, and we'll discuss that in a lot more detail. And we'll also go into the angles around the Labour Party or the Conservatives and the Labour Party, and potentially the Labour Party coming into power later this year. So the statutory residency test is the starting point. There are three, it looks like as if it's 1, 2, 3, as in 3 tests, but within each there's, sub-tests, you could say. So it's the automatic non-residency test. Then we look at the automatic UK residency test. And then we look at the sufficient ties test. Now, keep in mind that these tests are looked at in order of what you can see on your screen, because sometimes I have clients, they'll do some reading and they'll fair enough, they're trying to understand their position, fair enough, but then they'll straight away they'll start talking about their ties to the UK. But the ties doesn't really matter if you're going to satisfy one of the tests above. Okay, and this is a flowchart that I actually quite like. I've been using, before setting up ASWATAX. I used to use it in employment as well. It's nicely presented. This is a flowchart by KPMG. So effectively, and I'll go through the tests. Obviously, there's a lot more background detail, and that's what we look at when we advise clients. The background, the nuances, the very specifics. But broadly speaking, this is a very good starting point to look at. So the automatic non-residency test. So if you answer yes to any of these three here, then you are non-resident. So therefore, you don't even need to look at anything below that. So you don't need to start looking at all homes are in the UK, or do I have family in the UK? These are the ties at the bottom. So just keep that in mind. So not resident throughout the whole of the previous 3 tax years. So you're non-UK resident in the previous 3, and you're less than 46 days in the UK in the current tax year. So if that's the case for you or your client, non-resident in the previous 3 tax years and less than 46 days in the UK in the current tax year, you're non-resident. As I say, it doesn't matter of anything below that. If no, then we move on. And as I say, it's in order. It has to be in order. Number 2 would be around, you were resident in the UK in at least one of the previous 3 tax years, but you're less than 16 days in the UK in the current tax year, then again, you'd be non-resident. So for example, if you were resident in the UK in the previous tax year, let's say, but you were present in the UK for 17 days, then you'd be non-resident. And this is why proactive advice is encouraged. It's encouraged. Why? Because you can plan in advance. So for example, one of the reasons why the whole international tax field is dear to my heart, you could say, is because I'm a bit of a mover as well. So I spend a lot of time in the UK, Dubai and Saudi Arabia, currently in Saudi Arabia. And I have to apply these rules and look at all the nuances for myself first and foremost. And that's why I'm quite active when it comes to, or I'm quite proactive. I have to look at myself and for my clients as well. Then we come to the third, and this third one is quite popular, as in a lot of clients, and I'm assuming, individuals are not clients, but this becomes relevant to them. They rely on the third automatic non-resident test, which is you leave the UK to work full-time overseas, you're present in the UK less than 91 days, and you spend less than 31 days working in the UK. So that's where this whole 90 days comes from. You might have had 90 days. And this is the third automatic non-resident test that a lot of people tend to rely on. A common question that I do receive is, how would HMRC know that we spent less than 31 days working in the UK? So for example, you might be running a business from overseas, or you might be working full-time overseas, but you're in the UK for 90 days, let's say, and you spent your whole time working in the UK. Now the question is, how will HMRC know? The truth of the matter is, HMRC, it's difficult for them to prove something like that, but it's important. It's important to ensure records are kept, so everything's very clear. If HMRC were to ask any questions, then we move on to the UK residency test. So present in the UK 183 days or more in the current tax year. So if you were in the UK in the current tax year from 6th of April 2024, let's say, by the time, obviously we're in May right now, 22nd of May, but by the time we get to somewhere around end of August, early September, if any clients start to ask following that period of time, then automatically in my head is that you're UK resident. So your starting point is your UK resident, because it's not possible that any of these top three in terms of non-residency have been satisfied, and we show that you're in the UK for more than 183 days in the current tax year. The second one, this one is subjective. All homes are in the UK and more than 30 days spent present in that home, in the UK home. Now, again, this is where the nuances start to kick in. Even the third automatic residency test, there are a lot of nuances in terms of what do we mean by working full-time overseas, or what do we actually mean by 31 days spent working in the UK. I don't want to go into too much detail, otherwise we'll be here all day. So all homes are in the UK. Then we're starting to look at, what about if someone has 3 homes? 1 home in the UK, 1 home in Dubai, 1 home in India, for example. So how does it work then? And that's where you have to start looking at different things. And the third one is work sufficient hours in the UK. What do we mean by sufficient hours? So that's the automatic non-residency and then the automatic residency test. Then we come to the sufficient ties test. And this is after looking at the above two. So then you look at, was the individual non-resident in the UK throughout all of the previous 3 tax years? So then you say yes or no. So effectively, if you're saying yes, then it's inbound. The individual is coming to the UK. If it's no, then technically you're leaving the UK. So you were UK resident, but now you're leaving the UK. And in terms of ties, the main ones would be UK resident family. So that's broadly speaking, your parents, your children. And again, as I say, there's a lot more detail in terms of what do we mean by family. Substantive UK employment, so more than 40 UK days in the tax year. The people that leave the UK to work full-time overseas, occasionally they may be working full-time overseas, but for a UK employee, right? So it's very important to be careful in that instance. Accessible UK accommodation stayed more than 1 night. A lot of the times for clients, this is a straight tick, because more than 1 night. 1 night is nothing. And when in terms of the legislation, what they mean by accessible UK accommodation is very broad. So I think, if I'm not mistaken, I don't want to say anything incorrect, but I think even if you just stay at your parents' house, for example, or your children's home, that's accessible UK accommodation. Present in more than 91 days in the UK, so this is inbound, in either of the previous 2 tax years, which is unlikely on the inbound side, but on the outbound side, it is quite likely. And then for the outbound, we have the present in the UK more than any other single country. So for example, if I'm moving between UK, Dubai, Saudi Arabia, and we say 360 days in the year, let's just say. So if it's 120 days each, then you have to start looking at the specifics around that as well. We then move on to something called split year treatment. And there are 3 situations, and this is where I'll pull out my notes, because there are 8 cases in total. So 8 cases in total, 3 situations when the individual goes overseas, and 5 situations when individual comes to the UK. So in terms of the 8 cases, case 1, 2, and 3 are you're starting to work overseas, you accompanying a partner overseas, and or you're ceasing to have a home in the UK. So you're ceasing to have a home in the UK because you're going overseas. These are the situations when individual goes overseas and then can claim split year treatment. The other 5 cases is someone coming to the UK. When can they claim split year treatment? And I'll explain more what we mean by split year treatment. But the cases 4 to 8 would be starting to have an only home in the UK. Again, there are nuances. What do we mean by only home? Starting full-time work in the UK, coming to the UK after ceasing full-time work abroad. So, for example, you might have expats in Saudi Arabia, for example. They were working there. They're ceasing to work full-time in Saudi Arabia, and they're coming for full-time work in the UK. returning to the UK with a partner. So the partner thing is case 2 and case 7, and case 8 would be starting to have a home in the UK. So these are the cases where you can claim split year treatment. Now, what is split year treatment? Split year treatment, number one, is, just keep in mind, you can only look at split year treatment if you are UK resident. And that's why we said UK residency is the first thing to look at, because if you're non-UK resident, then split year treatment doesn't apply in and of itself. If that makes sense. So I've had a case where a client is trying to tell me that I want to claim split year treatment, but I'm pushing back to the client saying, no, let's look at residency first, because if you're non-resident, we don't need to look at split year treatment anyway. Being non-resident is more beneficial for you from, mitigating your UK tax rather than split year treatment. But then what split year treatment does do, so you are UK resident, what it does is it splits the year in half, meaning an overseas part and a UK part, or the other way around. If someone is leaving the UK, a UK part and a non-UK part. And what that basically means is that the UK element, you are subject to UK tax on your worldwide income and gains, but on your on your overseas part of the tax year, you are only subject to UK tax on UK sourced income. So it's very important to remember. It's very beneficial. Why? Because you don't want to leave the UK, for example, not claim split year treatment or not consider split year treatment, and for the whole tax year, even though you've been out of the UK for, 4 months, let's say you left in December, we're looking at tax years from 6th April to 5th April. Let's say you left in December, then and then you're still being taxed on your worldwide income and gains from December. That's not ideal, right? So therefore, we would want to claim split year treatment. Yeah, so that's fine. Okay, at this point, do we have any questions, please? Feel free to unmute yourself if you have any questions. If not, we'll move on. Okay, seems okay, good stuff. There will be another opportunity for questions towards the end. We then move on to something called the remittance basis. Now, the remittance basis, what is it? The remittance basis is a type, is a methodology in terms of taxing an individual. So, it's only available for individuals, not companies. But only those individuals who are UK resident and non-domiciled. Now, domicile will come to, and domicile is very, very relevant and important, especially in the current climate. But as I say, it's only available to UK resident, non-domiciled individuals. Now, again, similar circumstance where you have a non-UK resident, non-domiciled individual who had UK employment, done a bit of reading online, and is trying to explain to me that, no, Omar, I want to claim the remittance basis, but you're a non-UK resident. So why? We don't even need to look at the remittance basis. You being non-UK resident is better for you. It suffices. It suffices. It's enough. We don't need to start looking at anything extra. So just keep in mind, it's for UK resident, non-domiciled individuals. The default method now, the remittance basis needs to be claimed. I know it says automatic claim there, and that's in particular circumstances, but the remittance basis needs to be claimed in the majority of circumstances. Why? Because the default is the arising basis. The arising basis, and I'll explain the difference now between arising basis and the remittance basis. The arising basis is, just keep in mind, I said the remittance basis is only available for UK resident, non-domiciled individuals. So therefore, UK resident, arising basis, you are subject to UK tax on your worldwide income and gains. Worldwide income and gains. This is where the remittance basis proves to be useful for non-domiciled individuals, because they will only be taxed on UK sourced income, so not worldwide income and gains, UK sourced income, and only those funds that are remitted from overseas into the UK. Does that make sense? So effectively, you're sheltering, you're not being subject to tax on your worldwide income and gains. You might have income in another country. You might have income from the US, for example. But you are only being taxed in the UK on that US income if you remit it, if you bring it back to the UK. And that's why non-domiciled individuals, they really enjoy the remittance basis. Rishi Sunak, for example, his wife, there was this whole thing about the remittance basis. And, you know, loads and loads of non-domiciled individuals, high net worths, they would utilize this to protect and shelter their income arising offshore, because it makes sense in a way, right? You're earning, you know, money is accruing offshore. Why should you pay UK tax? And most likely you're paying tax in that country. It's definitely, if it's the US. The US are notorious when it comes to taxing individuals. In terms of the automatic claim, I've just made the note here. So the remittance basis applies automatically if there is no UK income. So no UK income. Very unlikely that is the case, because you're UK resident. So if you're UK resident, you know, broadly speaking, you'll be in the UK for a long period of time in the tax year. So how are you living? How are you surviving? And HMRC, they ask these types of questions. It's not just looking at numbers. HMRC, they start thinking outside the box. They put two and two together. How is this person surviving, for example? And the other method where it's automatic would be that the unremitted foreign income and gains is less than £2,000. Then it's just automatic. You don't need to make a claim. The remittance basis charge is relevant, and this is up to and including the 24-25 tax year. So we're talking about this current tax year. Why? Because from 6th of April 2025, there are massive changes proposed, potentially coming into play in terms of, you know, the whole domicile status, remittance basis. Broadly speaking, you know, right now it's not the time for knee-jerk reactions, just because there's a lot of uncertainty when it comes to this horizon. And I think it's a good idea to wait until the next party is elected end of the year before you start making decisions. Yes, you need to be aware, and broadly speaking, you need to start planning, but no knee-jerk reactions. So the remittance basis charge is that if you've been in the UK for at least 7 out of the previous 9 tax years, so keep that in mind. If you've been claiming the remittance basis, or if you've been in the UK for at least 7 out of the previous 9 tax years, then you have to pay, to claim the remittance basis, you have to pay £30,000 on top. So it's a charge. Okay, so you do your calculation. So in terms of how we would operate with the remittance basis, is always comparative calculations. Arising basis versus the remittance basis. We do the comparative calculations. We obtain all the records and the information from the client. Comparative calculations, now we know where we stand, and that's when we make the claim for the remittance basis, because sometimes it's not beneficial. And a lot of the times it doesn't become beneficial once the 7 year has passed, because you need to pay the remittance basis charge of £30,000. And if you've been in the UK for 12 out of the 14 previous taxes, then it's £60,000. So you see what the government are trying to do. They're trying to, yes, for 7 years you can claim, that's no problem. But if you're pushing it out, we're going to charge you 30k and 60k. Back in the day, there was a 90k charge, but that's been completely scrapped. Why? Because, so back in the day, just for context and just for your information, back in the day, it used to be, once you're in the UK, so we said 7 out of 9, 12 out of 14, then 17 out of 20, you'd pay £90,000 of the remittance based charge. But now, once you're in the UK for 17 out of the previous 20 tax years, you are deemed domiciled. How does that fit into our discussion? Because the remittance basis is only available for UK resident, non-domiciled individuals. So once you hit 17 years, you are deemed domiciled, and therefore the remittance basis is not available to he or she anymore. The remittance basis is relevant for both income tax and capital gains tax. We move on to something called foreign tax credit relief. Now, in terms of the kind of stuff that we do, we get involved in high-level tax planning. So if it's inheritance tax planning on, £10 million worth of assets, how do we pass it on to the next generation, things like that. Group restructures, property tax planning, and the rest of it. And then occasionally we would get involved in self-assessment tax returns on the more complex areas. And this is an area where when it comes closer to 31st Jan, following the end of the tax year, which is the deadline for the self-assessment tax return, this is the area that we tend to be engaged on in terms of a lot of uncertainty and a lot of questions around foreign tax credit relief. Foreign tax credit relief, broadly speaking, is in the name. So foreign tax credit relief. So you've paid foreign tax, you've paid UK tax as well, so you're getting the relief for the foreign tax that's been paid. So effectively, you're not paying tax twice in two different jurisdictions. You are taxed in the UK. So if you go back to basics, step number one is, when does this become relevant? Well, it becomes relevant if you're filing a UK self-assessment tax return, right? So that's step number one. And therefore, if you're filing step number two is, if you're filing a UK tax return, then you're paying UK tax. And step three is, however, Mr. Harry, he's paid tax in the US as well, or he's paid tax in, I was going to say Dubai and Saudi Arabia, but you know how it is out there. There's no income tax. So anyway, any other country, they've paid tax there. So this is the relief that we're claiming from a UK perspective. So sometimes it's about the logistics behind it, as in sometimes it might be that you have to claim back from the authorities in the other country sometimes. So it just depends. In terms of an example, this is actually from HMRC's guidance, and it's outdated in terms of the example, but the same principles definitely still apply, because I've definitely looked at it. So Zoe's total income is £50,000, employment income 48k, 2k foreign interest. So therefore the UK tax due based on the 21-22 tax rates would have been 8,160. But however, now employment income in the UK, just ignore that, because there's no foreign tax paid. It's the £2,000 of foreign interest. She paid £300 on the item overseas. What she does is she records the full £2,000 in the SA 106. So the self-assessment tax return has the SA 100 is the self-assessment tax return, you could say the body of the self-assessment tax return. Then you have the SA 101, which is additional information. And then from 102 onwards, is additional pages for something very specific. So for example, SA 106 is foreign income and gains. SA 109 is residency, remittances, and domicile. So for your information, that's what we mean by F2 of SA 106. Zoe's income without the foreign interest is 48k. Again, this requires a comparative calculation. We have to do a comparative calculation. The tax due on this amount would be 7,560. The tax due on the foreign interest is therefore 600. How? Because the total UK tax due is 8,160, less the 7,560 if we didn't include the £2,000 of foreign interest, therefore £600. As this is greater than the foreign tax paid, the credit relief is available at £300. So that's natural, right? That makes sense. You're not going to get relief of 600 because you only paid foreign tax of £300. And this is what needs to be included in box 2 of form SA 106. I hope that makes sense. In terms of foreign tax credit relief, there's 3 different methods in terms of claiming, and you have to utilize, and this is why I said comparative calculations, or even before that, you need to assess which method is the most beneficial for the client. Is it the treaty relief? So you have the double taxation reliefs. Is it the unilateral relief, or is it something called deduction relief? In terms of domicile, as mentioned earlier, the domicile status is particularly relevant for two particular angles. Number one would be the remittance basis of taxation. So we discussed that earlier, whether the remittance basis is available or not. And number two, quite importantly, and quite passionately, I would say, because this is a very important area that I advise clients on when it comes to inheritance tax, and it can make a world of difference. Because when looking at inheritance tax or being subject to UK inheritance tax, we look at the domicile position. So if you are a UK domiciled individual, you are subject to UK inheritance tax on worldwide assets. So worldwide assets. Now, on the flip side, if you're non-UK domiciled, then you are only subject to UK inheritance tax on your UK assets. And back in the day, pre-2017, in 2017, to be fair, a lot of the rules around this area, inheritance tax, particularly trusts, offshore companies, in 2017, that's when the rules were tightened quite significantly. So before 2017, you could own property through an offshore trust, which owns an offshore company, which owns UK land and property, and that wouldn't be subject to UK inheritance tax. But obviously now, it's not possible. There are other ways. We do explore other strategies when it comes to UK land and property, but broadly speaking, the rules have been tightened, and that's why it's important. That's why the domicile status is very important for individuals when it comes to inheritance tax. Now, 4 types of domicile: domicile of origin and domicile of dependence. It's more or less the same thing. But the domicile of origin, and I explain it a lot more in this video here. It's about a 15-minute video. I go through each of these 4. So feel free to watch that on our ASWATAX channel. But the domicile of origin is basically where your parents were born. So effectively, your parents were born in Barbados, for example, and you were born in Barbados. Sorry, it's about where you were born, but then you're also looking at the parents as well. I explain it a lot more in that video, and I don't want to go into too much detail. As I say, it goes into, it does get quite detailed, but broadly speaking, domicile of origin and dependence is pretty much your starting point in life. So where is your starting point in life? So if I was born in the UK, which I was, then I would be UK domiciled by origin, by default. And that's when domicile of choice comes in. And this is where it becomes a lot more relevant in this mobile world, where people are just moving left, right, and center. Domicile of choice is basically cutting off your domicile of origin and saying, okay, I was born in the UK. Yes, all my life, my childhood, my school, my social interests were in the UK. However, today I'm moving to Dubai. Okay, today I'm moving to Dubai, and from today onwards, I cut off all my ties to the UK, and my domicile of choice now is Dubai. So you see where the sort of thought process comes in terms of the domicile status, where the domicile of choice, obviously HMRC, they weren't born yesterday, so everything has to add up. Yeah, but we advise quite closely on domicile proactively. So if someone does have the intention of relocating overseas and, let's say never coming back to the UK, then there are certain angles that need to be considered and taken care of. The rules introduced in 2017, as I mentioned, everything was significantly tightened back in 2017. And along with the trust and the rest of it that I mentioned, with domicile, the rules were that once you are in the UK for more than 17 tax years, then you are deemed domiciled. So we don't care about origin, dependence, or dependence. you are deemed domiciled in the UK. And that's why it's important. This is an important point to make. Those individuals that have been in the UK for many years and they're coming up to that 17 mark, is important for them to seek advice, because there are planning opportunities available for non-domiciled individuals. So it's very important to keep that in mind. Okay, so for those coming to the UK, what are the key issues? So number one, I think for the next slide as well, residency position and the claim of split year treatment will be on both slides. So I'll just cover it once. You come into the UK, what date are you coming? Why are you coming? How long are you coming for? What are your plans in the UK? Who are you coming with? These are all initial questions that need to be considered. And then we look at we formally advise or comment on the residency position. Moreover, you come into the UK, fine, but you're only coming for a temporary purpose. So that's when we can start being proactive and say, okay, look, you're coming for this contract, but 90 days this and this, that, the other. So that's where we proactively advise. And claim of split year treatment, that's where we look at, is a claim for split year treatment available or not? Just one further condition that I didn't mention when it comes to split year treatment is that in order for split year treatment to be available in this tax year, I must be UK resident in the following tax year. Yeah. So if I'm non-UK resident in the following tax year, then I can't claim split year treatment in the current tax year. Then we have something called business investment relief. Business investment relief is basically, it's coming back to that whole remittance thing again. So as we mentioned, if you were paying attention, I hope I'm not boring you too much. If you're paying attention, then we said that UK resident non-domiciled individual will only be taxed on income or gains remitted to the UK, brought into the UK. And this is where business investment relief is available, because you might have a non-domiciled individual, let's say from China, Chinese national coming into the UK. Okay, so UK resident, because we'll be living in the UK, but non-domiciled, because the domicile of origin is in China. I feel like you guys will end up being tax specialists after this school. I'm not sure if I'm going into too much detail, but I hope it's beneficial. So this Chinese individual is coming to the UK, but he's coming for business purposes. He wants to set up a manufacturing business in the UK. Now, it's absolutely ridiculous. If he comes to the UK, he claims a remittance basis, but then he brings in £10 million cash to start this business. He's not going to do that, right? As in HMRC, again, they weren't born yesterday. They do have their heads clued on or screwed on in some areas. So that's where business investment relief is available. So you come to the UK, but you can, if the funds are brought into the UK for a qualifying purpose, and this is something that goes into a lot of detail, something we obtain advanced clearance from with HMRC. So we get HMRC's approval that, yes, this relief will be available, because you never know, right? And there are a lot of qualifying conditions that need to be met. But effectively, that's what business investment relief is. I hope that makes sense. And very importantly, and something that's heavily in the media currently, is excluded property trusts. Now, this is something, again, we get involved in quite a bit. Why? Because it's extremely useful, extremely beneficial for those coming to the UK. Because you have to remember, if you're coming to the UK, by default, broadly speaking, you will be non-UK domicile, right? Because you're coming to the UK, you're not UK domiciled. Yes, residency, you're coming to the UK, so you will end up being UK resident at some point, but you're non-UK domiciled. And we said that UK inheritance tax is only payable on worldwide assets on UK domiciled individuals. Now, this person this family is coming to the UK, and they have loads, as in their whole life, they've been overseas. So they own loads of properties overseas, loads of shares in offshore companies, loads of investment bonds, whatever it may be. Excluded property trust is the way around bringing those offshore assets into the net of UK inheritance tax. Excluded property trust. I'm not going to go into the details around it, but again, broadly speaking, prior to arrival into the UK, this is very important, prior to arrival in the UK, certain assets, and as I say, you have to get into the details, you have to be very specific, but certain assets are transferred into an offshore trust, an excluded property trust, and the effect or the achievement or the reason for this is that now these assets are out of your name, so even after 17 years, you can become UK domiciled. Or HMRC argue that, no, you have a domicile of choice in the UK now. That's fine, Mr. HMRC, but these assets, they belong to this offshore trust now. So it's and it's called excluded property trust. Why? Because the assets within that trust, and if it's done correctly and accurately, and the legal paperwork is in order, and this is something that we assist with, the tax advisory and the rest of it, these assets, so it could be £10 million worth of assets, are free from or safe for the future from UK inheritance tax. So it doesn't really matter what happens now. No UK inheritance tax. Now this is the bit where HMRC, sorry, not HMRC, but the Labour Party and the Conservative Party, this is the talking point, whereby they are saying that, and this is most likely going to come into play, and this is why clients are scrambling around trying to decide what to do. Shall we utilize this EPT or not? Because from 6th of April 2025, the rules around EPTs will be tightened and therefore subject to UK tax. As I say, no knee-jerk reactions yet, but these things need to be kept in mind. So I've got here that the EPT is for clients who are currently not domiciled within the UK and want to mitigate UK IHT when they later become domiciled. And this is also relevant for those that are coming close to that 17-year mark. So you know how I mentioned deemed domiciled, 16 years, 15 years, you should think about or potentially think about an excluded property trust. Leaving the UK, this is something that is becoming extremely popular, perhaps due to the rules that we just mentioned, which is the tightening since 2017, the tightening of rules for non-doms, for example, in 2020, and now from 6th of April 2025. The fact that innovation is being subdued, the R&D tax credit relief subdued, other reliefs being abolished, business owners, as in nearly every other day, have a phone call with a business owner who's not too happy with the current climate, or property landlords as well. And there's that angle where people are not happy, and there's the other angle as well, to be fair, which is aggressive marketing around Dubai in particular. And to be fair, these jurisdictions are quite attractive. So even in terms of, as in me, you know, moving around these three places, UK, Saudi Arabia, Dubai, I would comfortably say that for me personally, quality of life, you know, those kind of things, security, and people are starting to realize these kind of angles as well. So a bit off topic, but people are considering leaving the UK, and I'm talking about people from all types of nationalities. So it's not like it's fixed to a certain background. Honestly speaking, I'm speaking to all sorts of nationalities that are considering leaving the UK, and it can be for other reasons as well. It doesn't have to just be for tax, as I say, but tax is something that has to be considered. So as I say, residency position, claim of split year treatment that we discussed for someone coming to the UK, the residency position, okay, have we passed that August-September mark? Yes, okay, you're UK resident, but then, you know, we start looking at split year treatment, splitting the tax year in half. Changing domicility, as mentioned, are you looking to obtain a domicile of choice now? That's very deep work, and that's very sensitive, you could say. Number 4 is how how you will be taxed as a non-UK resident individual. Now, this is the part we advise on quite extensively, because you've been taxed in the UK in a certain way: employment income, PAYE, property income, self-assessment tax return, whatever it may be. But how will you be taxed as a non-UK resident individual? So what do we need to do before leaving the UK? For example, Form P85 to HMRC to let them know that you're leaving the UK. Or I have shares in, this is my trading company. So myself and my wife, for example, are shareholders in this trading company. How will we be taxed now? Is it PAYE? Is it salary? How will the dividends be taxed? And we'll come to disregarded income. The property will come to non-resident landlord scheme, and so many other areas. It is very, very detailed, is very advanced. International taxation is extremely complex. Okay, it's extremely complex. And then as soon as you mix it in with anything else, whether it's property, inheritance tax, businesses, then it just becomes a whole. It becomes a minefield, and that's why it's very important to take care. When both coming to the UK and leaving the UK, because I've seen some horror stories. And number 5, very important. This is very important. This is free advice to anyone watching this. I think I've got a video on the temporary non-residence rules as well. But this is relevant for dividend income from a closed company and capital gains tax. 2 areas, very, very, you have to be very careful. Broadly speaking, you might own a portfolio of stocks and shares, let's just say. Current market value is £1 million. You purchased these shares about 10 years ago. So I don't know, the purchase price would have been £200,000, let's just say. Now, £800,000 is subject to UK tax. If you are in the UK currently, you sell those shares today in the UK, then you pay £800,000 at 20%, which is £160,000 UK tax. But you know that you're moving to Dubai or Saudi Arabia or wherever you're moving, Portugal. Portugal is the common location in Europe, Spain, Greece, and then obviously there's the Far East as well that people go to. The US is the flip side, which is people are flocking out of the US and to the UK, for example. So the US is quite notorious when it comes to taxing people. I think, if I'm not mistaken, I have looked at a few cases, but broadly speaking, those individuals, so even if you're non-US resident, you're still taxed in the US, and then you have to do all these reliefs and the rest of it, claim all these reliefs. But so as I was saying, in terms of the example, you're moving offshore. So the advice there would be, don't dispose now, dispose, in 6 months' time or in a year's time. Why? Because you won't be subject to UK tax. But then the temporary non-residence rules is that if you are a non-UK resident for less than 5 years, then those transactions come back into the UK tax net, and HMRC will charge you on the day. So you literally arrive at the airport, Heathrow Airport, and you're being taxed on £800,000 at 20%. So be careful and always seek advice. Same goes for the dividends from closed companies. Disregarded income. Disregarded income is basically disregarded income. I'll quickly go through this example, live example that we worked through previously. But what disregarded income is it's a particular relief that's available to not tax UK interest and dividends. As in, there's about 16 on the list, 16 bullet points, something like that. But the main ones are dividend and interest. Now, an individual might have UK sourced income. So you have salary, interest, and dividends. And it requires comparative calculations. But broadly speaking, you disregard the dividend income and the interest income. What does happen though is that you lose your personal allowance, and that's why comparative calculations are required. So if you can see my screen, Kalpesh, can you see my screen, the Excel screen?
Yes.
Yeah, excellent. Okay, thanks. So effectively, what we had is an individual who was looking to leave the UK, had self-employment profits of £150,000, rental income, this should say rental income of £24,000, and state pension as well. So 186,500 is the income. Now, keep in mind this term, self-employment. 186,500 income tax liability, close to £70,000. Now, client has told me that I'm going to be leaving the UK, so I'm going to be non-resident. So I start thinking about disregarded income. Why? Because I know that dividends can be disregarded. But in order to have dividends, you can't be running a self-employment business. You need to be, it has to be dividends from a company. You can't have dividends from self-employment. It has to be from a company. You have to be a shareholder in a company. So if you do the same calculation and compare, look at the tax difference. You have profits of the company now. Yes, you need to pay capital gains tax, corporation tax at 19%, fine. But the £126,000 here is now taxed as a dividend. We can disregard the dividend completely. Yes, we're losing our personal allowance. Okay, sorry. In this particular example, you're losing your personal allowance anyway. Why? Because your income has exceeded about 126,000. But in other examples, you would lose your personal allowance. But look at the tax difference. So you have the income tax liability, but then you have the further tax deducted in respect of disregarded income. And then you pay your tax in terms of the UK income. So the maximum UK tax liability is £17,000. The annual estimated tax savings would be £20,000 per annum going forward. £20,000 per annum going forward, which is broadly speaking the 70,000 there, less these amounts here. So that's the tax saving of circa £22,000. So you can see the benefits of disregarded income. Hope that makes sense. Okay, non-resident landlord. Non-resident landlord, again, it's in the name. You are non-UK resident, so we're not talking about UK residents here. We're talking about non-UK residents, landlord, therefore you own UK land and property. Broadly speaking, what we have is you have the non-resident landlord that receives UK rental income from UK land or property. Okay, UK land and property receiving rental income. Now the problem for HMRC is it's difficult for them to chase you. You're in an offshore, you might be in the Cayman Islands, for example, fully exotic. But it's difficult for HMRC to chase you. So what do? They impose obligations on either the tenant or the letting agent. Now, and this angle is missed in the sense that sometimes tenants, letting agents, they're fairly clued on now, as in the rules were introduced not too long ago. I can't remember which year, but letting agents are now clued on. Previously, I used to advise letting agents as well on these particular rules, but tenants sometimes are unaware. And what happens is HMRC, they expect the tenants or the letting agents to, how did I word it? Okay, I can't see there, but effectively what they're trying to do is HMRC are imposing the obligation that the tenants or the letting agents deduct the tax before paying over to the non-resident landlord. That's basically in a nutshell. There is a method to continue to receive gross income, and this needs to be done via the NRL1 form. So you need to fill out a form to HMRC, and there are certain conditions that you need to meet. But broadly speaking, again, in terms of compliance and reporting, this non-resident landlord would need to be filing a UK self-assessment tax return under any circumstance. Because you own that UK land and property, you must be filing a UK self-assessment tax return. There is, there is a lot of uncertainty or confusion when it comes to a UK company owning UK land and property and the shareholder is non-resident. That's something to seek advice on. Employment-related issues, overseas workday relief, something to be considered. Again, it's a particular relief that's available. National insurance is a minefield. National insurance is an absolute minefield, as well as payroll. How does the payroll work? If I'm living in the UK, I have a UK employer, but then I move overseas. Okay, fair enough. That's for the UK employer to more or less sort out. But you as an employee, you still have your own obligations. And then on the flip side, individuals coming to the UK, they might want to know how they are being taxed. And there is another common scenario, which is you run your own business. So you are the shareholder in your own trading company. You were on the payroll. Now I'm moving offshore. What should I do? What's the best thing to do? And along with that comes the whole national insurance. I'm telling you now, national insurance is an absolute minefield when it comes to employment in and of itself, but when you mix it with the international tax aspects, overseas, moving offshore, then it becomes extremely, extremely complex. To be honest, I'm not an expert in national insurance. My colleague is. As in we can't be experts in everything, right? So this employment side, broadly speaking, I would say this is my, as in after VAT, this is my second weakest area. Case studies, very quickly. Sorry, I wanted this to be less than an hour, but we're coming up to the hour mark. A Hong Kong national, he was actually the husband, wife, and 2 children. They were moving to the UK. Why? Because was it 4 children? There were 4 children in this particular case. They were moving to the UK. This was about 2 years ago, and for the children's education. So 2 of the children were going to university. The other 2 were still a bit younger, but they wanted to move to the UK for this purpose. Now it's a wealthy family. They sought my advice once they came to the UK, and this is the issue. Round of applause for seeking advice. Yes, you've come to the UK now, but the takeaway from this case study is that you should seek advice prior to coming to the UK. I know it's sometimes difficult to even think about or consider, but that's where, as an advisor or any accountants on this call would raise the awareness at least. Why? Because overseas assets, we talked about excluded property trusts, there's still potential planning around that, but there's also something around mixed funds. Now, this is a very complex area, but it's relevant for the remittance basis, and mixed funds is something, is a pitfall. You need to avoid mixed funds, but broadly speaking, the income tax, the amounts that she's remitting now is from a mixed fund. It could have been from a clean fund. There's something known as clean capital. She could have remitted her funds from that clean capital and therefore pay no UK income tax, even though you're remitting income. Because it's a clean fund, there's no UK tax. But because it's a mixed fund, it's like the worst case scenario. So that's case study number 1. And case study, and effectively, these are case studies, but they're more like things that I've seen in practice, and why I sort of hold this webinar or talk about certain matters is because of these kind of scenarios. And case study 2 is we had a Saudi individual owning 2 properties, just 2 properties, but central London, and the value was £9 million, passed away. Family have no idea what's going on. Nobody knows what's happening. Even as in the father that passed away himself, he had no idea himself that, okay, if I pass away, then there's this potential 40% tax on £9 million. Well, 9 million less 325 or less 650 if you want to be clever, but that's still nothing in the grand scheme of things. Paying 40% tax, remember you have to pay inheritance tax within 6 months of death. So the family, the children, they ended up selling one of the properties. Then when you sell the property, you have to pay capital gains tax, most likely increased in value, and therefore it's important for non-residents and non-domicile. So you know, non-resident, non-domicile, you think you're perfectly safe, but that's not the case when it comes to UK land and property. And these rules were, you know, as I say, they were tightened in 2017. Previously, as I say, offshore trusts, offshore companies. What we're doing now is something that we get involved in regularly. I've got 4 cases on the go with this, is dismantling these offshore structures, because now, as I say, UK land and property, whether it's directly owned, indirectly owned, is subject to UK tax. So is bringing no benefit from an income tax perspective, from an inheritance tax perspective. It's just sat there in the Cayman Islands or whichever jurisdiction, and you're paying, and the trustees offshore, you know, they charge hefty fees, annual fees, and therefore it's about dismantling these trusts or these structures tax efficiently. So you have to be careful. So how can ASWATAX help you? I sort of went through, as we're going along, you know, scenarios that we get involved with. So I don't want to take too much of your time, but broadly speaking, international tax or any of the matters discussed is something that we can help you with. I hope you found it beneficial and I hope you found it useful. Do we have any questions? That's fine, no problem. I think everyone wants to leave for lunch now. It's actually 3 p.m. here, so I've had my lunch, so sorry guys. But yeah, we shall speak to you guys soon. If you do have any questions, feel free to, you know, reach out via email, LinkedIn, and the rest of it. I'm happy to answer. We do have another webinar. So the second one will be tax planning specifically for business owners throughout the business life cycle. So I hope to see you there. As I say, I sincerely hope you found this beneficial and useful. And yeah, we'll keep in touch. These are my contact details, and speak to you guys soon.